On Tuesday, Congress passed the Jumpstart Our Business Startups. In case you missed that, that's the Jobs Act, the acronym. As a side note, anytime Congress passes a bill with a cute acronym, you should be very suspicious of it. It's just a tangent there. A House vote was 380-41, overwhelming majority, achieving what House Minority Leader Eric Cantor called, quote, an increasingly rare legislative victory in Washington where both sides seize the opportunity to work together. The Jobs Act eases regulations on small businesses and entrepreneurs by rolling back some of the investor protections in the Sarbanes-Oxley Act, which was passed in 2002 as a reaction to the Enron and WorldCom scandals. Its sponsors contend it will make it easier for small firms to raise capital. The White House, which is expected to sign the bill, enthusiastically applauded Republicans and Democrats for working together, saying it was, quote, pleased Congress took bipartisan action to pass key initiatives the president proposed last fall to help small businesses and startup grow and create jobs. Professor William Black, Henry Pontel, and Gilbert Geis also thanked Congress for the bill, writing, as experts in ferreting out sophisticated financial frauds, we write to thank Congress and the president for preparing to adopt a Jobs Act that will provide us with job security for life. This bill is an atrocity. Congresswoman, since we have you here, I believe you abstained the first time it was before the House, voted for the bill the second time it came up. You're smiling. What's your feeling about this piece of legislation?
Well, this legislation came out of the President's Jobs Council. It was recommendation, and I don't see it as a great jobs bill. I don't see it creating a lot of jobs. Passing the transportation bill would. That would create investment in our infrastructure and create a great number of jobs. It's really to help startups and entrepreneurs and the next Apple company. One of my amendments on it was that they had to register with the SEC. So the SEC can come in and investigate. But after the Enron scandal, we passed an auditor, a very tough auditor review, outside auditors. It's very costly. Every small business in my district complains about the requirements. It's costly for small businesses. Larger businesses can assume the cost. It's a way to allow these smaller companies, whether it's crowdfunding or allowing them to advertise. It was a way to sort of try to jumpstart and allow these smaller companies to gain capital liquidity, which is very difficult to do. Also joining us at the table, returning, Alexis Goldstein, formerly of Wall Street, now with Occupy the SEC. You talked about this bill and sort of warned us, our viewers, about the bill, but back before it passed, then it did pass. The Congresswoman, I think, just articulated what the supporters of the bill say was the intent. What is your sense about what its effect will be?
So the problem is this defines a new class of company called an emerging growth company, which is defined as a business that's basically worth $1 billion or less. That's a huge company. And one of the things it says, and there's a lot that's wrong with this, is there used to be this thing that's this wall between the research side and the investment banking side. If I'm an investment bank taking a company public, I'm not allowed to send out a research report telling you why it's so good and why you should participate in the IPO, because that's a conflict of interest. Right. The Jobs Act tears that wall down. Another thing that it does, you mentioned it tears down part of Sarbanes-Oxley. It says if emerging growth company goes public, for 5 years after they go public, they do not have to do any of the accounting under Sarbanes-Oxley.
It also expands the category of enterprises that don't have to register with the SEC. So there's now all sorts of ways in which you can raise capital, and the SEC isn't able to peer into the internals of that. William Black joins us now, Associate Professor of Economics and Law at the University of Missouri, Kansas City, Senior Regulator during the savings and loan scandal, and the author of the book, The Best Way to Rob a Bank is to Own One. Bill, it's great to have you.
Thank you. It's great to be on.
You wrote that letter about this piece of legislation. Why are you so concerned about it?
Well, fundamentally, what this is doing is taking to the world of equities the shadow banking system, what it did in the world of debt. And we've just seen what creating opaqueness does in the world of debt. It produces a global disaster.
Let me just translate that. So what you're saying, let me just translate that. What you're saying is the financial crisis was essentially gestated and grew to full strength in the bond market. It was securities that were bonds based on mortgages. You're saying
and the derivatives market.
And the derivatives market. What you're saying is this is going to move the same sort of things that create crisis into the stock market. When you say equity, just so that people know equities and debt, from the bond market to the stock market. Because when we're talking about small companies raising capital, we're largely talking about them selling stock to raise capital. Right. Continue. Sorry.
That's correct. And derivatives in this case were debt derivatives. These were based on people's mortgages, which are, of course, a debt instrument. And it's called the shadow financial system because it wasn't regulated. And we've just seen that that produces the most criminogenic environment you can imagine. That just means an environment that produces really widespread fraud. Now, take that to equities or stock issuance. This is the dream bill for every pump and dump scam in issuing stock that you've ever heard of. And we already had endemic problems way beyond the SEC's capacity to deal with those kind of frauds. And now we've made it open season for these frauds. It is truly an atrocity. We have truly learned nothing from our crises.
Will you explain what a pump and dump scam is and why it would be easier, to your mind, to do that under this new legislation?
Sure, and one of the things is this cloud financing stuff. So pump and dump is I tout the stock. You know, I send out all kinds of emails saying it's going to be the greatest thing, that prices are going to triple, and I buy some shares to start the movement in the price. And then a whole bunch of unsophisticated investors come in, that raises the price of the stock, and then I dump my stock knowing that it's going to be a disaster while I can still profit, and everybody else is left with the tremendous losses. That is a daily occurrence in terms of small stocks and micro caps and things like that. And this is going to expand that world. As your guest said, this is not tiny companies. This is allowing this for really major enterprises that can cause devastating losses.
I want to get reaction from Alexis and the Congresswoman right after we take a quick break. Congresswoman, I want to get your response because obviously Professor Black is very critical of this bill. Alexis is critical of the bill as well. I'm just curious your response, and I guess I'm also curious in how, when a bill like this comes before the House, what is the sort of process even by which a decision is made on this, particularly when it's dealing with things that are fairly technical?
Well, first of all, Congress is focused on one thing. It's jobs, 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 the recovery of the economy. When President Obama took office, this country was shedding 700,000 jobs a month. We are climbing out of that. We are now, last month we gained 222 jobs, not enough. We are desperate to get our economy moving. The President and the Democrats have come out with extensive programs to create jobs. Everything from the transportation bill, which we can't seem to pass, which seems to be like simple, invest in your roads and your trains and move people and create jobs while you're doing it. And all of the President's jobs program was defeated by the Republicans with the exception of the help for the veterans. And there was a feeling that we really needed to do something. This was actually came out of the President's office. The President supported it. And it's a feeling of how do you create new high-tech opportunities. Now, one thing about Congress is that you can change things the next day. That's one of the things that we have with Dodd-Frank. There's a tremendous effort to push back on the fundamental disclosures and transparency and requirements for trading on open exchanges that are fundamentally huge for the country. So this was an area where the President's Jobs Council, the President's people, the administration, thought we could possibly create some jobs. If there is abuse, you can come in and change it. One of my amendments said you have to register with the SEC. That gives the SEC the opportunity to come in if they think there's a problem, but it doesn't require all of the Sarbanes-Oxley, which was the auditor's reform bill, after the Enron scandal.
But it doesn't seem to me that a company of $1 billion should be exempt from Sarbanes-Oxley accounting. And these companies are exempt for 5 years after the IPO. And I think another point, so you mentioned this could help tech startups, but tech startups don't need help. There's huge amounts of venture capital flowing into tech companies. The other thing I think people fail to glean from this bill is this isn't necessarily just about startups. An emerging growth company could also be a company that a private equity firm took private and then flips. And 2 years after that, because of the Jobs Act, they're only required to disclose 2 years of financial records.
Bill Black, Bill Black, I just wanted to, because the bill has the acronym jobs, as both an economist, a former regulator, a lawyer, I'm curious what you think about the job-creating potential of this. The problem that it was supposed to be addressing is a decline in IPOs among small-cap firms. This is what people have pointed out as the problem that needed solving. And I'm curious what you think about its job-creating potential.
Yeah, and a doctorate in criminology that specializes in elite financial crimes, and was actually a successful regulator on these things. Okay, so first, this is an anti-jobs act. The Congresswoman is certainly correct about the enormous losses from the Great Recession. What she hasn't added is that Great Recession was driven by massive fraud by our most elite financial institutions. And when you encourage fraud, and that's exactly what this bill does, you destroy jobs. You destroy millions of jobs. Now, what was the logic on why we had to deregulate before? It was we had to supposedly win the regulatory race to the bottom with the City of London. And that's the argument, that if we actually regulate effectively, the fraudulent startups will move to the City of London. I think that would be an excellent idea. I would much prefer the Brits to bail them out.
Outsource the fraud across the Atlantic. You know, I'm going to quickly read from SEC Chair Mary Shapiro, her letter to Congress on March about this piece of legislation. Too often, investors are the target of fraudulent schemes disguised as investment opportunities. While I recognize that H.R. 3606 is the product of a bipartisan effort designed to facilitate capital formation and includes promising approaches, I believe there are provisions that should be added or modified to improve investor protections. Bill, you just referenced the sort of last big round of bipartisan deregulation that happened in the late 90s that in many senses paved the way to the crisis. I want to talk more about that right after we take a break. Hello from New York, I'm Chris Hayes. With me this morning, I have New York Congresswoman Carolyn Maloney, Kai Wright from colorlines.com, Alexis Goldstein, formerly of Wall Street, now with Occupy the SEC, John McWhorter, professor of linguistics and American studies at Columbia University, and by satellite, we have William Black, author of the book The Best Way to Rob a Bank is to Own One, and associate professor of economics and law at the University of Missouri, Kansas City. Congresswoman, I want you to say something you said to me just now about Mary Shapiro should send you a letter.
She should send all members of Congress a letter on everything she thinks should be added for investor protection. I will introduce the bill, and I will work hard to pass it. It took me 4 years to pass the Credit Card Holders Bill of Rights. You can work on this. Now, when they say they need it because we need more IPOs, at one point there were articles that we were behind China.
Right.
But if you look at China, their IPOs is they sell it to themselves. They put up the IPO and the government buys it. So it's not really a real IPO. So I would say still our country is leading in many ways the IPOs that are worldwide.
Kai,
I have a question because I think this is important. Is that so the theory is that there's a problem for capital formation for small businesses, and then there's a debate about whether or not what is a small business, right? So, but my question for Professor Black and for you are is that true? Is that theory correct? And if it is, what is the solution to that?
Let's go to Professor Black. You want to take a shot at that?
Sure. No, there isn't a crisis in funding. Banks are incredibly liquid and incredibly reporting profits.
But they're not lending.
What's the problem? Right. And the problem there is private sector demand. We're in still the recovery from a terrible, terrible recession. And when you don't have strong private sector demand, you aren't going to have much willingness to lend because they're going to be afraid of losing their money. The U.S., as Alexis said, has by far the greatest venture capital sources of funding. So we have many sources of funding, in particular for high tech. So the high tech stuff is a complete made-up argument in this context. China is a good place to mention because China, when the SEC started looking, it was a whole series of securities and accounting fraud because they don't follow Sarbanes-Oxley principles. And this bill is going to make foreign efforts also easier because it's going to overwhelm the resources of the Securities and Exchange Commission. So you asked me, what leads into these things. We have had three major crises in recent times, starting with the savings and loan debacle of roughly 25 years ago, then the Enron era, and now the current one. Each of these was triggered by an epidemic of fraud at the most elite financial institution level. And each of those epidemics of fraud was produced by substantial, completely bipartisan deregulation. So every time we get this kumbaya moment, when the Democrats and the Republicans start thinking good things about each other, you should hold your wallet because it's a disaster.
Let me read. This is Phil Graham, chair of the Committee on Banking, Housing, and Urban Affairs at the 1999 signing ceremony for Graham-Leach-Bliley, which was called the Financial Services Modernization Act. The world changes, and we have to change with it. We have a new century coming, and we have an opportunity to dominate the century the same way we dominated this century. Glass-Steagall, in the midst of the Great Depression, came at a time when thinking was that government was the answer. In this era of economic prosperity, we have decided that freedom is the answer. Here's then Democratic Senator Bob Kerrey, who looks like he may be running again in 1999. The concerns that we will have a meltdown like 1929 are dramatically overblown. This is Clinton Treasury Secretary Larry Summers at the time, 1999. Today, about the same bill. Today, Congress voted to update the rules that have governed financial services since the Great Depression and replace them with a system for the 21st century. This historic legislation will enable American companies to compete in the new economy. So I think it gets to this question of trust in some ways, right? I mean, because things do change, right? I mean, I think one of the things that when I first started looking into the jobs bill, it seemed appealing to me because I was clicking on Kickstarter projects, right? And Kickstarter is this very neat website where someone has an idea and people can pledge money to it. And I thought, yeah, it's true. Things are different now, right? We're in the internet age and Kickstarter is awesome. And then I started looking into the details of it. But how do you, I guess this is a broad question for you, Alexis, but in terms of thinking about modernization, in terms of thinking about, yes, there are new ways of trying to make these transactions work. Modernization has become a synonym for deregulation, but is there another way to conceive of changing our rules to respond to the way things are changing that isn't deregulation?
Of course. I mean, I think that you could have had this Jobs Act with investor protections put into it and allowed people to sort of raise money in form. Kickstarter is a good example, but that's for sort of art projects, right?
Sure.
So the idea is, how can I sort of crowdfund my new business? Right. And I do think that that's a worthwhile endeavor, but I do think that you owe it to the people that you would be trying to crowdfund to disclose about something about your business. And part of what was so heinous about this before the Senate weighed in and amended it is there was a lack of disclosure that was required. And I think you have this really important question, which is, how do you address capital formation? How do you force the banks to lend? I don't have an answer to that, but I know that deregulation isn't the answer. You said the bill got better in the Senate? Yes. Well, how did it get better in the Senate? So there's a lot of portions to this, and one whole section is about crowdfunding. So for one example is if you were a company and you hired someone to pump your stock, you did not have to disclose that you had hired someone to pump your stock. And the Senate amended that to say, no, you have to disclose this.
Well, I tell you what, I'll put in every idea that you have to improve this, that balances using the new technologies that are part of our world now, of the internet and other ways to fund and interact. I'll introduce it in Congress.
We're making it. I want to hear. Alexis Goldstein is twinkling.
I like it.
I want to tell a story from a personal experience.
Please.
When they started deregulating, just very briefly, after the Great Depression, we enacted three great reforms: FDIC, the SEC, and Glass-Steagall. And when they and we gave us 50 years of economic prosperity. When they started deregulating is when we got in trouble. But just to tell you what it's like, Brooksley Bourne is an attorney here in New York. She was the head of the CFTC. They were pushing to move off the exchange the energy derivatives, which were the most powerful derivatives. And she and others came to me, this is horrible, do something about it. I put in a bill that said you don't do that. You keep the derivatives on the exchange, at which point Greenspan comes and testifies, take it off, we need to be competitive. Snow, who was then Secretary of Treasury, and Cox, the SEC, all come in and say this is bad policy, don't do it. And of course it went to a vote, and I couldn't even get the Democrats to vote with me. So when they have this run towards deregulation, it's a huge challenge. And one of the most important reforms of Dodd-Frank is really Glass-Steagall modernized, called the Volcker Rule, which would say you don't trade for your own account. So you're not competing with your customers, and your customers are your customers and your top priority.
Right.
What you see is people going into customer accounts, competing against,
we'll talk about that.
dumping stock into customers that they don't want, and it's because of this proprietary trade.
Well, so
are the forces that are working against progress, as I think all of us at this table would consider progress, are they not resistible? You're talking about how you can't get the votes. You're talking about what people did. Is there a change possible in terms of legislation, something that somebody would send you, or are we talking about needing a cultural kind of change, which, of course, is more difficult to conceive of? Can anything be done about this?
I think it's very difficult to take on financial interest. I worked so hard on the credit card bill. I use that as an example because it's easier to use an example than to talk about ideas in the sky. Because I couldn't even walk down the street without hearing about a credit card abuse where I'm paying on time, I've never been late, and yet they raised my rate retroactively on my balance, and I can't get out of debt. And that bill that basically cracked down on abusive practices, it took 4 years to pass.
Right.
And it was the first credit card reform in 30 years.
And that's something extremely tangible, unlike some of the more in-the-weeds stuff. Alexis?
So I wanted to ask you, you mentioned Dodd-Frank, and I think that's really important. And you also mentioned that Brooks Liborn was pushing for putting derivatives onto exchange. But
they were on the exchange. They were being removed.
So the Commodity Futures Modernization Act deregulated over-the-counter derivatives and made the market opaque. You are actually the co-sponsor of something called the Swap Execution Facilities Clarification Act that rolls back part of Dodd-Frank that allows for more pre-trade price transparency on derivatives. So my question to you is, if you agreed with Brooks Lee back then, why do you disagree now, and why do you think we should have less transparency? Why are you supporting
I am
that?
totally for transparency. I was on the conference committee. I was with Barney Frank when he was in a sweat every night to see if he could get the votes to move anything forward. It's a democracy. And the CEF bill called for different exchanges. So it all has to go on an exchange. It has to be printed at the end of the process and before the process.
Yes.
That bill passed out of the subcommittee with a total vote from the Democrats and the Republicans, and it passed out of the Agricultural Committee with total votes of the Democrats and the Republicans. And my point is that any means of trade should be able to be exercised. New York is very much a voice exchange in some houses. They like to talk about it.
But that's because voice is profitable, and New York...
Okay.
Yeah,
but then you have to print whatever it is and get it out there
and so
for
why
other
are you,
people.
But that's transparency. That's good.
Yeah, I'm for that. I'm for that. The bill as put forward said you had to have
six... The bill says you cannot... The bill
You had to have 6 bids. What happens if you don't get 6 bids?
Wait a second.
Then you're going over 5 bids. What happens if you don't get 5 bids?
It's my show, and I'm totally confused. So I think that means that we have to take a break. Bill Black, professor of economics and law at the University of Missouri, Kansas City. Thank you for joining us today. I appreciate you doing it. Job security and stability have been liquidated in Wall Street's workplace. While it reshapes corporate America in its image, anthropologist Karen Ho is going to be with us in a little bit.